What the Reserve Bank's focused on is what it calls the underlying rate of inflation, or the ongoing inflation rate, abstracting from what it regards as artificial or temporary influences such as government measures to assist with cost of living pressures or movements in prices of things like food and fuel. The underlying inflation rate which the Reserve Bank focuses on is called the trimmed mean. It cuts out the top 15 and bottom 15% of price changes. In other words, it focuses on the middle 70%. And that measure rose by 3.5%. Now, that was down from 4% in the March and June quarters of this year, but it's still well above the Reserve Bank's 2 to 3% target band, and particularly above the midpoint of the 2 to 3% target band, which is 2.5%. There are a couple of other things about the inflation data that will have bothered the Reserve Bank. First, services inflation over the year to the September quarter was 4.6%. Now, that was actually up slightly from 4.5 and 4.3% in the June and March quarters, respectively, and was unchanged from a similar figure over the year to the December quarter of 2023. In other words, over the first 9 months of this year, there's been no progress in reducing services inflation. Relatedly, the statistician tells us that almost all of the decline in inflation could be attributable to slower growth in the prices of goods and services whose prices are set globally or by reference to what's happening to those prices globally. Whereas what it calls non-tradables inflation, that is the prices of things that are determined largely by what's happening here in Australia, prices like housing, for example, or childcare, rose by 4.1% over the year to the September quarter. And again, that's way too high for the Reserve Bank to be comfortable that inflation is sustainably heading back into its target range within a reasonable period.